To Roth or not to Roth? That is the question. And up until now, you could ask the question. But if you're a high earner and you're making over $150,000 in 2026 and you want to maximize your retirement contributions, you don't really have a choice anymore. So you're going, Forrest, I haven't heard of this. What are you talking about? This video is about in 2026, there is a provision that is going into effect where if you are a high earner making $150,000 or more and you have access to an employer-sponsored 401k plan, which is most of you watching, that is your primary source of retirement income. If you are making the full amount of contributions as an employee, which in 2026 is $24,500, and you make catch-up contributions, you really want to maximize what you put in your plan, that's an additional $8,000. It will need to be made on a Roth basis. That is because at the end of 2022, there was a congressional act called the Secure Act 2.0. In it, there were many retirement provisions, some of which have already taken effect. But this provision was not actually set to be implemented until now. So starting January 1, 2026, this will be what you have to do. But I want to introduce another planning variable into this discussion. If you want to maximize the money that's in your retirement plan, you may want to consider doing something called a backdoor Roth IRA contribution. You do not have to do it just inside your 401k. So my name's Forrest. I'm a certified financial planner. I'm the owner of Brightworks Financial Planning, and I love to do these educational videos. This is not for personal financial tax or investment advice. It's just to educate you. I hope that you find this helpful. Please like, subscribe, and comment. I'd love to know what kind of content you love. But without further ado, on to the video. Okay, guys, welcome into the video. So today, what I want to discuss is I have a case of Bill and Jane. I'm going to show you on the screen their net worth, their investment makeup, and what that actually means. So in this case, Bill and Jane are 55 years old. They want to retire. And in the context of our video, we're going to be discussing the new rules in 2026 for those that are considered highly compensated employees inside their 401k. Bill and Jane have a decision to make. So in addition to the current assets they have, their big question is, should I save in the Roth catch-up, or are there other options that I should pursue? So what I want to make a case in this video is, how can you look at the decision to do Roth catch-up contributions versus other alternatives? Now, there's really one other alternative, and it's called the Backdoor Roth. You've probably heard of it. I will explain it in this video, but I'm going to show you the pros and cons of doing this internally or externally. And there's going to be a couple factors that you're going to have to consider. Before I go into those, I just want to give you the lay of the land. So Bill has been a dedicated saver. He has a company 401k plan. And in this case, he's able to amass $1 million by age 55. So these clients assumed are age 55, so they are eligible for a catch-up in their retirement plan. Now, I'm just going to show this on Bill's account. The purpose of this video is not to go through all the details and show you exactly how this client couple would retire, but I do want to show you what's really important. So if we have $1 million in an investment account pre-tax, that's the assumption. We also have a joint brokerage account for Bill and Jane at $500,000. And then finally, we have a Roth IRA for Bill. So what I have assumed here is that we do add a Roth catch-up. Now, the question is, are we going to do it inside the plan, or are we going to do it outside the plan? And the reason being, I'm just going to go into cash flow quickly here and show you that the reason it's important to add more Roth dollars in this plan is because we go to summary and we go to accounts. You can see currently there's only 250 at the start of the year. If they continue adding with investment growth, by the time we get to 65, which is when this couple wants to retire, we want to try and even out these income sources. So we have more in a taxable account, we have more in a Roth. Our largest bucket is still going to be our traditional or tax deferred money. But the point of this video being, we want to try to be as advantageous as we can along the way to get to a diverse mix of assets for distribution in the future. So that's just the lay of the land. But I want to back up for a second and talk about what is this new rule? How does it work for 2026? So if you make over $150,000 and you're a W-2 employee within your company's 401k plan, you have the ability to do a catch-up contribution. So just to kind of write a couple things on the screen here, the maximum that you can defer as an employee into a 401k in 2026 is 24,500. Now you can do another catch-up, okay, which is going to be an additional $8,000, okay? So the catch is most people that are earning 150 or more are going to defer this 24,500 pre-tax. Okay, I'm going to write that by pre-tax, which just means it's going to go in before your taxes are withheld. And then when you get your W-2, the amount that you actually have as your salary, it will not be the full amount. It will be subtracted by whatever you deferred, this 24.5. Now, up until 26, you could also decide to defer an additional 8,000 pre-tax. Now, to be fair, this is indexed for inflation. So in 2025, this number was not 8,000, it was 7,500, but the principle remains so that you could still defer that and defer the taxes on that so that when you get your W-2, it will subtract the total amount that you deferred on a pre-tax basis. Now, before we go any further, I just want to give you a quick rundown of how this actually works. So let's take $150,000. Okay, that is on a monthly basis, that's 12,500. Now, if someone wants to try to hit that 24,500, I'm going to run through what that would look like on a monthly basis. So here are my assumptions. You want to try and hit that full amount. So you're going to defer before taxes $2,041.25. Now this isn't exact, but it's going to get you really close. So if we just take that and we do a little math on that, we're going to take away that. That means we're left before taxes 10,458 and 75 cents. Now here's where that's important because at this point you're going to defer a certain amount and it's called tax withholding. So when you get your paycheck, everyone's going to have to withhold for Medicare and Social Security. So I'm removing this from that equation because it's going to be there regardless. But what I want to show you is let's just say you defer 15%. So then what you're going to do is you're going to multiply this by 15% and subtract that amount. So I'm going to kind of do that for you here. So we're going to take away 1,500. Sorry, it should be a 668.81. So doing the math on that, we have 10,458 and 75 minus 1,568.81, and you arrive at your net check. Okay. So I'm just going to write net here equals, and this is going to be 8,889.94. All right. So far you're going, Forrest, you're boring me. You're just showing me math numbers. Why do I care about this? The reason is I wanted to go through the math on how pre-tax works because I want to show you how Roth works. So I'm just going to draw a line here in the middle. And on this side, we're going to have Roth. We still have the same 12,500. Okay, so the amount you defer is always based off gross. So again, you're still going to take out that 2,041 and 25 cents. The question is, when does it come out? And in this case, it comes out after tax. So we're going to move this part up. Okay, so we're going to take this, we're going to multiply that 15%. And in this case, I do realize likely this would be higher than 15. I'm doing this on the federal side. I realize everyone watching this may be in different states. So I want to try and make this as simple and as straightforward as possible. So in this case, we take away we're going to take away 1875. Notice 1875 is higher than 1,568 and 81 cents. That's where the difference comes from. So if we take this 12,500 and we minus 1,875, we get a starting point of 10,625. Okay, but we're not done. Now we have to subtract the 2,041.25. Okay. So if you're tracking with me here, we have 10,625 minus 2,041.25. Net check, $8,583.75. Okay. Very obvious here. We're losing cash flow, right? So another way to say this would be difference equals 8,889.94 minus 8,583.75, roughly $306. Okay, that's on a monthly basis. Okay. So just for easier math, let's annualize that. Okay, that's $3,674.28. All right. I know this is getting a little messy, but if you followed along, pause the screen, maybe have to go back a little bit to make sure you're following me, but I tried to do that slow enough so you understand. So when you do Roth elections, you are obviously paying the tax now. That just means your paycheck gets smaller. So you're going to have $3,674 less in your pocket throughout the year. So that's one consideration that you need to think about. Now, the next thing that I want to show you is you don't have, this doesn't have to be your only option. Okay, so one option is you can go ahead and do that. You can say, all right, I'd rather just pay the taxes now. I want to have less cash flow. I can handle that. That's not a problem. But in this case, what I wanted to show you is what is another option that can be equally as smart and a little more tax efficient while you're still getting Roth dollars. Because we're not debating whether Roth dollars are good. We actually would agree that in most cases, if you want to do the catch up and you were thinking about it anyway, you have to decide, am I going to do this within my plan or am I going to do this outside of my plan? So let me go ahead and introduce the option outside of the plan, and that's called the backdoor Roth. Now, if you're watching this video, you probably know what this is, but I'm going to define it anyway. Okay. So there is a certain income threshold where you cannot contribute directly to a Roth. And the reason I made this a client couple is to make sure that they are over the threshold. So remember that $150,000 number. But if both couples make 150,000, their gross income, adjusted gross, would be around 300,000. Now, this number is going to be indexed for inflation. Every year it's going to change. In 2025, it was, as a couple, it was $246,000. So obviously they're going to be above that. Now, here's one thought. If this is where you're at from an income perspective, there is no income limit inside a 401k. So your salary could be $1 million and you could still defer Roth dollars in a 401k. But what I'm talking about is a backdoor Roth refers to an IRA. That's your account. It's outside of your employer. It's something you own forever and it's portable. It's not tied to your employer account. Now, here's the catch. That is not going to be funded through payroll. So if you're going to do the catch-up contributions, you're going to have to accept that your monthly payment is going to be less. So the backdoor Roth, for a lot of people, they go and do it once a year because what you actually do is you do there's really multiple steps. Step one, you're going to make a contribution. I'm just going to say contr for abbreviation's sake to a traditional IRA. Okay. And you're going, hey, Forrest, I thought this was a Roth IRA. I'm confused. The reason it's traditional is because after that certain threshold, you cannot deduct it. So that is a non-deductible contribution. So I'm just going to put ND here. Okay, because it's non-deductible, another way to say it is it's after tax. So when you go to do your taxes, you cannot deduct that contribution. Now, here's the next step. What you do from there is once you make that traditional contribution, now in 2026, for someone who is going to be over 50, that number is actually going to be similar to what you can do for the catch up. So that's why I'm kind of doing this as an apples to apples comparison. I'm just going to use 8,000 as a number. So in the catch up, in your plan, you can do $8,000. Outside, we're going to do $8,000. And I want you to see that even though we're contributing the same dollars, you can do it in a smart way. So the second step is then you have to then wait for that to settle in your traditional account and you then convert. Okay, so conversion is not the same as contribution. You convert to Roth. Now, this does come with some additional tax steps. There's a form called the 8606. This video is not personal financial tax or investment advice, it's just for education, but that is something you would want to be aware of. You would have to file that correctly in order to make sure this was done properly. Now, ideally, in between these two steps, you want, I'm just going to do a less sign and time. You do not want a lot of time because if time passes between those two steps, it could be 6 months, a year, 2 years. That contribution was after tax, but the growth, you would be taxed on it when you convert. So if you do this very, very soon after you do the traditional IRA contribution, most, if not all of this will be tax-free, which why it's called the backdoor Roth. You're going in through the back door through a conversion. Okay. So hopefully you understand that. Now, what I want to discuss here is the way that's funded is typically through savings and it's not cash flow through direct payroll deduction. Now, why would I say that in some cases I would actually say this would be a better route instead of just doing the Roth catch up? Hear me out here. So now I'm going to move away from the whiteboard and I'm going to go into a scenario that I created and I'm going to talk to you through this. So remember how we discussed how these taxes are assessed, meaning through payroll, right? It's pre-tax or after tax. In this case, if we do the Roth catch up, I'm just creating this for a client couple. So on the left here, you're going to see income numbers. I'm going to scroll up for a second. And this is what you would actually see. You're actually getting a view of how this would flow through to your taxes so you can think through this. So remember I said they both make $150,000, which would be 300 adjusted growth. That would be their total gross, right? But if we do the full amount for both of them, and we do the catch up, right? So where did I get 251 from? So if you take 24,500 and you just multiply that by two, that's 49,000. So 300,000 minus 49,000 equals 251. So we would detract this slightly and we would say from 251, we're going to do a catch up. In this case, we're just going to do $8,000 for one couple here. So in this case, it'd be 243. Okay, so this number would be 243. All right, so hopefully you're following how I'm coming up with this. The point here being, what is their actual taxes on that amount? Okay, so if I scroll down here, what you're going to see is if we just assume the standard deduction, which is pretty straightforward, they're going to get that 243. We're going to take away the standard deduction. And then we're going to get a taxable income of 210,000 and we're going to have total tax of 35,800. Now, what I want to contrast for you is remember that $300 or roughly $300 that we saved if we do pre-tax versus Roth. So what I would suggest here is I'm going to make this a comparison to you and show you what would this look like if we actually did this through, I'm going to make these similar, okay? If we did this out externally instead. Okay, so the only difference here is $8,000, right? Because we're actually not deferring that. And let me make one small change. Remember, even though the Roth is going in, sorry, I'm correcting this. This is correct. So this should read 251 because even though that additional 8,000 is going in, remember that is not tax deductible. So this is correct, 251. So if we do that externally, we don't get an additional tax benefit. But what can be helpful is instead of doing that Roth instead of doing that Roth catch-up contribution in your 401k, if you do the backdoor Roth, what you can do is, and this is an additional strategy, is I think that if you're not already contributing to an HSA, this is the key to unlocking this scenario. So in 2026, if you have a family plan for an HSA and you're over 50, you can take the full 8,750 and you can add an additional $1,000. So you can deduct another $9,750 for that contribution. Now, here's why that's cool and important. You're already deferring on your payroll deduction pre-tax for your 401k contributions. Instead of doing the catch-up Roth, you're doing an additional contribution to the HSA, which is also pre-tax. So that's why I spent so much time going through the calculation for you in terms of how this is calculated, because you have more money in your pocket. Now, theoretically, that more money in your pocket could be saved throughout the year to then come up with the backdoor Roth contributions with a combination of the money you're saving just because you're putting in pre-tax and now the money you're saving because you're putting in the HSA. Now, I want to give a caveat here. I realize that this is completely a fictional scenario. So in some cases, you may not be able to do both, but if you have the excess cash flow, I think it makes a lot more sense to do this because you're actually impacting your taxes along the way. And here's why. So what I'm showing you here is these two numbers left and right. These are reflecting the total tax you would do on these two scenarios. So remember, 3717 minus 35,424. Okay, the difference, 2,293. Okay, so I'm going to wipe this old one and show you. So we have 2,293. And remember, we had an additional 3,600 of savings if we chose to continue to defer on a pre-tax basis versus Roth, right? So we're not even having that. So what I'm thinking here is, in your mind, for an accounting perspective, you can add these up. And basically that's 58.99 in your pocket. Now, math is one thing, behavior is another. So you would have to actually account for that throughout the year. So what I'm saying is, if you put forward these two strategies, not only do you lower your taxes, but you also can take the cash flow that you are accumulating throughout the year to make your backdoor Roth contribution instead of just putting it directly from your monthly cash flow. Now, again, this is something where everybody has to make their own decision, but I personally think that this strategy could be more effective. Especially could be more effective if you do this for higher levels, because then the amount you defer is going to be subject to whatever that marginal tax rate is, and it's more effective for people that are maxing out. If you're only putting in 5% or so on your contributions, you're not really going to hit the catch up in the first place. So this is a very specific scenario for a very specific set of clients. But I wanted to demonstrate this to you because there are other ways that you can impact your cash flow along the way in terms of taxes. This is also more important if you're a high earner, because you want that extra 97,000, or sorry, 9,750 to be an above the line deduction on your taxes. So you want to combine these strategies. Now, whether you do the Roth internal or external, completely up to you. But I do think that the backdoor Roth gives you more flexibility because you can do this once a year. You can do it at the end of every year and decide, do I have the cash flow to do this? And throughout the year, you could actually use extra cash flow that you got from pre-tax, whether you want to invest in a taxable account. It just gives you more flexibility. So in my conclusion, I think you should use the HSA account, the health savings account, in addition to maxing out your pre-tax 401k, so that you could still get your Roth dollars, maybe even have some taxable dollars along the way, and still not be locked in to having to do that catch up along the way and losing your ability to flex what you use the money for. So hopefully this was helpful, and I would love to get your feedback on it and see what you thought. I'd love to continue doing more of these. Please like, comment, subscribe. Again, this is a fictional account. It's not meant to be financial advice. It's not tax advice or investment advice. The whole goal of this education and what I do in Brightworks Financial Planning is so that you're educated and that you are prepared as much as possible for retirement. So please, again, share, comment. Love to see what kind of content you like to see, and I'll see you on the next video.